What if the global money supply was written in code, not, controlled by humans?
Hmm.
That question, and maybe the answer coded into Bitcoin, is why the whole financial world is watching this one event right now, the halving. Welcome back to the deep dive. Our mission today really is to cut through the confusion, the hype, the jargon. We're going to break down the technical side of the Bitcoin halving, try to understand its economic significance, which is pretty profound, and look at the different predictions about what it means for the market. We've got a good stack of sources here to help us.
Yeah. And look, before we dive in, it's crucial we clear up some common mistakes people make.
Yeah.
The sources are really clear on this. The halving is not a stock split.
Yeah.
Okay. Your Bitcoin stash isn't doubled. It's not cut in half. And the price, it definitely doesn't just instantly get chopped in half or shoot up on the day. That's just not how it works.
Okay, right.
Yeah.
Good to get that out of the way. So let's unpack this then. If it doesn't change the coins I already have, what is this thing, this programmed event?
Fundamentally, it's a hard-coded reduction. It cuts the rewards that Bitcoin miners get for, securing the network. Think of it as an automated monetary policy. It's built into the software, happens at a set time. Oh, not time, set block. And it takes human meddling out of the supply equation.
Right. And the whole power of Bitcoin, why this matters, it comes down to scarcity, doesn't it? This fixed supply, only ever 21 million coins, makes it kind of like digital gold. But how do those coins actually get out there?
Yeah, good question. It's all through mining. New Bitcoin gets created when a miner successfully validates a bunch of transactions that the block and adds it to the blockchain. This happens on average about every 10 minutes. And the miner who does it successfully, they get compensated in two ways.
Okay.
First, they scoop up all the transaction fees.
Mm-hmm.
People pay those fees to get their transactions included in the block, and it's driven by, supply and demand for block space.
Mm-hmm.
Second, and this is the big one for today, they get the block subsidy.
Ah, the subsidy. That's the core of the halving.
Precisely. Right now, that subsidy is 6.25 Bitcoin per block. The rule, written right into the code, says this subsidy gets cut exactly in half, down to 3.125 Bitcoin. And it's not triggered by a date on the calendar, but by the block count. Every 210,000 blocks, bam, it happens.
I like the analogy some sources use here. It's kind of like a giant global raffle, right? Running constantly. A winner gets drawn every 10 minutes or so. Miners buy tickets with computing power. The halving doesn't change how often the raffle runs or who wins. It just shrinks the prize money.
That's a really good way to picture the immediate impact on miner revenue, yeah. And for anyone watching the clock, or rather the Block Explorer, this next halving in 2024, it's expected around April 20th. It'll happen officially when the network hits block height 840,000.
It's just the design is kind of brilliant when you think about the math.
It really is. And if you zoom out, look at the big picture, this whole mechanism ensures that the release of new coins slows down over time. It asymptotically approaches that 21 million limit, which for anyone not into math just means we get closer and closer and smaller steps, but never quite technically hit it in finite steps. The very last fraction of Bitcoin, the last Satoshi, is estimated to be mined around the year 2137. So it's this century-plus long, predictable schedule. And understanding the history of these cuts is important too, the scale, When Bitcoin launched back in 2009, the block subsidy was huge, 50 BTC per block.
Wow, 50.
Yeah. Then the first halving, 2012, cut it to 25 BTC. Second one, 2016, down to 12.5 BTC. And the third, 2020, that brought us to where we are now, 6.25 BTC.
And it's just a funny coincidence, but because it's roughly every 4 years, it often lands near U.S. presidential elections and leap years. Kind of a neat marker in time, even though the block height is the real trigger.
But the really significant thing, and the sources hit this hard, is the contrast in monetary policy. You have Bitcoin's policy, programmatic, transparent, running like clockwork, you could say, defined by code, immutable.
Compared to traditional central banking, which the sources frame quite differently?
Exactly. They contrast Bitcoin's fixed schedule with what they often describe as discretionary and sometimes opaque decisions made by central banks, like the Fed's FOMC. They even point to things like, those insider trading scandals with officials like Kaplan, Clarida, Bostic, instances where human judgment and, frankly, lack of transparency can really erode public trust. The argument from these sources is that Bitcoin's programmatic issuance is, in a way, a form of ethical money because the rules apply the same to everyone verifiably.
Okay, let's shift to the economics of this halving. People throw around the term supply shock. How big a deal is the actual reduction in new coins hitting the market daily, considering how big Bitcoin is now?
Right, so the math is simple. We go from about 900 new Bitcoin created each day down to 450. Now, cutting 450 BTC a day, that's not nothing. It's a significant reduction in the new supply flow. But context is key.
What's the context the sources give us?
Well, the relative impact is much smaller than previous halvings. Think back to 2012. That first halving cut daily issuance from 7,200 BTC down to 3,600. That was a drop of 3,600 coins per day.
Huge difference.
Massive. Especially when you consider the total amount of Bitcoin back then was tiny compared to now. Today we've got, around 19.6 million BTC already out there. The market cap is in the trillions. You have huge institutional players now. Look at the BlackRock Spot ETF, fastest growing ETF in history apparently. It can soak up hundreds of millions of dollars worth of Bitcoin daily. So that immediate supply squeeze from cutting 450 coins a day, it's likely much less dramatic, less of a shock than it was in those early cycles. Okay, let's tackle that recurring fear, the FUD, fear, uncertainty, doubt about the miner death spiral. You hear this every halving cycle. The basic idea is revenue gets cut in half overnight, miners with tight margins go bust, they switch off their machines, the network grinds to a halt, and boom, implosion.
Yeah, sounds pretty scary, like the whole security model just falls apart. Why is that fear mostly, unfounded according to the sources?
It comes down to one of Satoshi's really clever design choices, the difficulty adjustment. So yes, absolutely, some less efficient miners, maybe those paying high electricity costs, will likely have to unplug their older machines right after the halving. Their revenue drops 50%, costs stay the same. They become unprofitable. And if enough miners turn off their rigs, the total network hash rate, that's the total computing power securing the network, it will drop.
Okay, so fewer miners means blocks start taking longer than the usual 10 minutes.
Exactly. But here's the clever bit. The Bitcoin protocol itself is watching this. Every 2016 blocks, which works out to roughly 2 weeks, the protocol automatically recalculates the mining difficulty. If blocks were taking too long to find because hash rate dropped, the protocol makes the mathematical puzzle easier to solve.
Ah, so it adapts. How does making the puzzle easier help the miners who are still running?
Because if the puzzle is easier, the remaining miners, who are typically the more efficient ones anyway, need less computing power, and therefore less electricity, to find the next block and win the reward. Their costs effectively go down relative to the difficulty, their profitability recovers, and the block time gets pulled back towards that 10-minute average. So you don't get an implosion, you get like a cleansing. The less efficient miners drop off and the industry becomes leaner, stronger, more competitive. The network heals itself. It's designed for this.
All right, now for the big one, the price question. Historically, halvings seem to kick off these huge bull runs, right? Is this time different? We see all this institutional money coming in, massive ETFs. Are we basically guaranteed a price surge in the next, say, year and a half?
This is where we really need to inject some skepticism. Take that contrarian view that some sources highlight. Look, yes, the past 3 halvings did come before massive rallies. The sources show clear price surges after 2012, 2016, and 2020. No denying that correlation. But the market today is it's a different beast. It's far more mature, way more institutionalized. There's a strong argument from some veteran traders and analysts we looked at saying essentially, look, everyone knows the halving is coming. The data is practically known years in advance. This supply cut is predictable.
So they're saying it's already factored in.
Exactly, that the market has priced it in. The halving itself, in this view, becomes more of a narrative, something that maybe excites retail investors, rather than a fundamental shock that moves sophisticated markets. And we should be really clear here, based on the sources. Anyone claiming they know what the price will do in the short term around the halving, they're probably, either mistaken or trying to sell you something.
Right. Predicting short-term moves is a fool's game.
Pretty much. Volatility is almost guaranteed. But the timing and extent of any future rally, fundamentally unknowable.
Okay, so given that uncertainty, that volatility, what's the practical takeaway for someone listening? What do the experts suggest?
The overwhelming advice, consistently across the sources from experienced people in this space, is don't try to time this. Don't treat the halving like some get-rich-quick trading event. Instead, the recommendation is usually to focus long-term. Think dollar-cost averaging, making regular steady purchases regardless of the price swings. Treat Bitcoin more like a long-term savings technology, not a short-term gamble. That strategy helps smooth out the volatility around events like the halving.
That makes sense. Which brings us to the really long-term picture for the network itself. Eventually, way down the line, around 2140, that block subsidy goes to zero. Gone. If miners aren't getting that subsidy anymore, what keeps them mining? How does the network stay secure?
Yeah, this is maybe the most critical long-term dynamic baked into Bitcoin's design. It's absolutely essential. As that subsidy dwindles every 4 years, Transaction fees have to become a larger and larger part of the miner's revenue. They need to make up the difference. This creates this built-in economic pressure for fees to become more substantial over time. And that's why the whole debate around block size, keeping block space somewhat limited, is so important to many. It ensures there's ongoing demand, ongoing competition to get into a block.
Which keeps the fees up.
Exactly. High demand for limited space means users are willing to pay higher fees. And those fees are what will incentivize miners, what will pay for network security, long after the last block subsidy is paid out. The network transitions from being secured primarily by inflation, the subsidy, to being secured primarily by usage, the fees. Hashtag had outro.
So wrapping this all up, the big takeaway seems to be that the Bitcoin halving isn't some instant magic button for the price. It's more of a predictable, slow burn programmatic event. It defines Bitcoin's scarcity, sets its monetary policy apart from, human-run systems. It's really about the long game.
Absolutely. And maybe a final thought for people to chew on. Just ask yourself, what did the network actually do when the subsidy dropped all the way from 50 BTC down to 6.25 BTC over the last decade or so? Did the security collapse? No. The hash rate, the measure of that security, it just went parabolic. It skyrocketed. What does that history tell you about how anti-fragile this system is designed to be? It doesn't just survive these subsidy cuts. Arguably, it gets stronger because of them. It sheds the weak links.
That's a powerful point. A really insightful deep dive today. Thanks for breaking that down. Hope you found this useful. If you did, please do follow, like, and share the show. It really helps. And for more insights like this, you can follow What Bitcoin Taught Me on Twitter, X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn. We'll catch you on the next deep dive.